Own rental property? Stop before you claim a tax deduction. Repairs equals deduct now. Improvements equals spread over 15, 27.5, or 39 years. Welcome to Ivy Tax and Business. You're watching Ivy Smart Tax by FC. Let's break this down and help you save big. Step 1. Understand the key difference. The IRS classifies property expenses in two ways. Repairs like fix and maintain equals immediate tax deduction. Improvements like upgrade or extend life equals depreciated over 15, 27.5, or 39 years. Depreciation rules. Qualified improvement property QIP is 15 years for interior, non-structural improvements. Residential rental property is 27.5 years. Commercial property is 39 years. Common mistake: treating all property expenses as repairs. This raises red flags with the IRS. Pro tip: if you must improve the property, see if it qualifies as QIP for a 15-year write-off instead of waiting 27.5 or 39 years. Step 2. Maximize repair deductions. Keep clear records. Get detailed, itemized invoices from contractors. Use similar materials. Match the old one to classify as a repair. Make repairs while tenants are there. It's easier to claim a repair if it's occupied. Common mistake: upgrading to luxury finishes or adding new features. This turns it into an improvement. Pro tip: small fixes? Get separate invoices to classify them as repairs. Step 3. Separate repairs from improvements. How you structure expenses can determine tax savings. Keep repairs and improvements on separate invoices. Track expenses properly. This makes tax season easier. Common mistake: mixing repairs and improvements on the same invoice. IRS may classify everything as an improvement. Pro tip: even if an expense is an improvement, cost segregation strategies may help accelerate deductions. Want to keep more of your rental income? Follow for expert tax tips.